Good morning, good afternoon, good evening, wherever you are. Thank you for joining us for today's public webinar. Good morning, Jim.
Good morning. Good morning. All right. In case you don't see it, we do a very short video every weekend, and it's called the week ahead. What is in front of you right now is the graphic that was used in last week's video, and we were talking about, when you see this exactness, that's a sign that it's weak, laggard buyers. And of course, they got the inventory very long, and then of course you got some pretty severe liquidation. Weak laggard buyers came back again, got a little balance, and you got liquidation again. Laggard buyers came back again, and of course we got liquidation yesterday. When you do your homework, it is so important to understand who you are competing against, because it's going to totally change the potential outcomes. Now, also, can you put the text up from the weekend, please? Is that possible?
I don't have that, Jim.
Oh, okay. So one of the things that I said in the weekend was that there was a large area at about the 5750 level that was a huge area for the institutional market makers. So let's take a look, Jen, put up the profiles from the last couple of days and spread out Mondays. All right, look at the low on Monday. The low on Monday is 57.57, right at that area that I was talking about. Then you had this huge rally back up to the highs. What happened in here is, when I have identified that area, that 5750 area, is that's the area that I thought, at least from some sources, that would really squeeze some of these big institutional hedges. And of course, if it got down there, that could trigger buying because the hedge had to be readjusted. And that's exactly what happened. And this was late in the session. So what happened here is the institution, they had to buy in order to adjust the hedge. Because there's been no indication of longer term money in this market, it's been almost all very short term traders. They looked on this and everybody jumped on the board, and you got the short covering and the market all the way back up to just a few ticks from the all-time high. I mean, absolutely unbelievably thin. But what's happened when you have a market that we've had here for some period of time, where there is no meaningful participation by the longer time frame that I can see, that it is almost all very short-term, weak hands, laggard traders. When we opened and showed the graphic and the exactness of how it fits, the trend lines, that is how very short-term traders trade. They're looking for the exactness, and the trend line was just exact. And then as I said over the weekend, if you come back down through that trend line, watch out, because that's going to bring you probably liquidation, because they're long at the same time. Then they will, they'll jump on it and go the other way. So if you look and see what happened yesterday, that's exactly what happened. The market got crazy long, and then over the weekend, and then or over Friday, and then we come in yesterday with crazy long, very weak hands inventory. Then we get rumors, not rumors, but we get information that, there's more conflict, more military conflict, in the world. And that Israel is, there's going to be, Iran's going to, send missiles into Israel. And of course, the market, once you get that liquidation, and then the market goes crazy and everybody jumps on board, and you get this severe liquidation. But notice on that liquidation, let's see the bottom of this, please. Notice once again where the market went to. Now, this is not a good low. I mean, it's a weak low because of its exactness to this multi-day low. So this yesterday was liquidation, not a more potent combination of liquidation and new money selling. You have to, so many times people get carried away with extreme views and what can happen and what might happen versus looking at the market and reading what the market does. So a lot of times people would say, oh boy, the institution really going to get some selling. They didn't sell. They've seen, they may be wrong, but their attitude is, we've seen this before. You get a little bit of an initial shock, and then the market comes back, and maybe they even buy the dip. So it didn't scare the senior money. And all you got yesterday was liquidation, not liquidation and a combination of new money selling. Now we come in today and we've got a very narrow range. We don't have any meaningful, we have excess on yesterday's low, but when you combine it with the low from the 20th, this is a weak low. This is very exacting, very mechanical traders buying exacting levels. So I don't know what happened, but all I'm saying in here is, one, market yesterday was liquidation, not a combination of liquidation and new money selling. The high, we don't have any real security on the high because there's no real meaningful excess on the high. In fact, the all-time high was made in Globex, and we know that that's unlikely, to be lasting. It may, but the odds are against it. So we don't have anything to write home about the high. Let's go down and look at yesterday's low again. And we don't have anything to write home about yesterday's low. So as we're coming into this morning, it's a lot of short-term trading. Now, let's go back to the graphic again, the weekend graphic. So there's what it looked like. Now, RJ, can you bring up the current daily bar so we can see what happened? I mean, this is this line and this is the support. Okay, if you can bring up a current daily bar, and let's take another look at it.
Okay. RJ, I'll give the screen to you.
Yeah.
Okay.
Okay.
Okay. So you see what happened. It broke through it the day before, but then I explained that, late in the day, and you got that institutional buying. But here again, you get the breakdown yesterday below this bar, mechanical. This is where short-term sellers were trading right on the line. When they went through the line of the that we'd shown on the weekend, the selling came in. Very mechanical, very mechanical. That's when you see that mechanical nature, that tells you who you're competing against. So now as we come into today, you're looking at yesterday's low is a pretty significant low because it is not a good low. It's got excess low on the daily, but it matches a previous multi-day low, previous what, 1, 2, 3, 4, 5, 6, 7. So it's an 8-day low down there. That certainly is nothing to write home about. So confidence remains very low in this market. Now you look and you say something else that I've noticed over here, and I don't trade this market off of another market, but that doesn't mean I live in a vacuum. The bonds, well, I'm looking at I think the 10-year over here, and pretty soft. Yields are up. Remember, there's an inverse relationship. So you've got a little pressure on yields this morning. Okay, so now as we get ready, and then Jen will do a short commercial, then I'll take questions. I am very short-term neutral coming in here this morning. I have some spreads on, and I've got taken in some pretty good premium, but I do not have an open. I don't have an unbiased position in here. I mean, I'm neutral as to what this market can do. Okay, Jen, why don't you do a short commercial, and then we'll take questions.
Okay, 1 second. Let me take the screen. Okay, can you see my screen?
Yes.
Okay, we still have several hundred subscribers who have not done the confirmation on their list yet, if they joined our mailing list. Obviously, people who were on our previous platform before, I think majority of them are okay, because I know some of them wrote in to make sure. But if you have joined our new mailing list in recent weeks, there's a chance that you did not respond to the confirmation opt-in email. So just reminding you about that, and if you're new and you want to join, you can go jimdalton.com/subscribe to join here. Also for new folks, you can also do that right here. And to refer to the YouTube video that Jim mentioned that we do weekly, the week ahead, here's our official YouTube channel. Right now, we are still advertising for our fall intensive that's going to run from October 16th to November 15th. And our limited time discounted bundles are going away as of Sunday, October 6th. So this coming Sunday will be the last day that you can purchase them. And because we do have a prerequisite requirement of the Foundation Application Market Profile e-course. So right now we do have bundles that you get a discount for purchasing more than one course. You can see those on our courses page. And I just wanted to let you know that in the email that we sent out this morning, if you are in our emailing list, with regards to reminding you about today's webinar, there's a code hidden in there, 50 off, so that from now through Friday, if you are wanting to purchase one of our bundles so that you can join us for the intensive, you can get an extra $50 off. Okay, so that's valid from now through Friday at 11:59 p.m. Eastern time. Okay. Oh, 1 second here. Okay, and excuse me, my throat is dry. If you're looking for details, you go on the view detail of each product, but I will also mention that for the intensive, you get access to your materials for 1 year after the course finishes so that you can go back and review everything. And we have the tentative schedule listed there too. Times are posted in Eastern. You can convert that for your time zone, but we have a lot of clients that live in time zones for which they can't always attend all the webinars live, and also because maybe a lot of them have day jobs, but they don't want to miss this intensive. And so you join live whenever you can, and the recordings are there so that you can catch up or review over the next year after it finishes. For those of you that are going to do the bundle, I would say you need to focus on the foundation e-course from now till the start of the intensive. The more that you understand those basic concepts on a deeper level, the better off you're going to be when we hit the ground running on day one. And Jim, I didn't know if you also wanted to mention the last article that we had this past Monday that was the third in a series of 6 that we've been doing and sending out on Mondays. So if you're interested, if you haven't already subscribed to us and you want to read that series, be sure to subscribe to our emails and opt in on the confirmation email. But Jim, you can mention that here about the
Okay.
telltale morning, the telltale morning market confidence.
The 6 articles are really general information, but they're also a great prelude for those that are going to take this final intensive. And we say final intensive, it's the last long intensive that I'm going to do. We'll do other educational programs, but the intensive is about 4.5 weeks. I'm 84, and it's just 4.5 weeks. It's very tiring for me. So this is going to be the last one. Obviously, I would like it to be the best that we've ever done. It's a wishful thinking. I hope it's more than that. But the 6 articles that we're doing, one each Monday for 6 weeks, are really the 6 things that I selected as the most relevant to my trading career over going on 6 decades. Last week's article, or the one that came out this week rather, was on, judging early morning confidence. And what you find is that so many times people always say, oh, trend days. Well, a trend day is going to have high confidence from the opening. Most good odds it'll have high confidence from the opening. When confidence is lower, and you get a feel for what is high confidence, low confidence as time goes on. But when confidence is lower, you have a greater odds that you're going to get rotational market environment. Now, I think probably one of the most important things in this last article was I talked about what I call camouflaged high confidence days. An example would be overnight inventory is long. We know there's a high confidence of a counter auction relative to overnight inventory. So you had overnight inventory long, you get a counter auction or selling relative to overnight inventory, and that is met by buying, high confidence buying, and that may camouflage what is really a trend day. So again, there's nuance, everything is nuanced, but you have to be aware of that. But that's in the article. Next week's article is going to be centered on what I've reflected on over the years, some of the biggest errors I've made in trading. You always have what you need to have happen to say break even, or what it is, or meet your goal, or what you want to have happen, or what you need to have happen. How many errors I have made over the years, focusing on the market and that price. Boy, one more tick and I'll break even. We take exceptional risk, so much silly risk to break even, it gets on our ego. But next week's article, it's, to broaden the attention to it, so many errors are because we are focused on what we want to have happen or need to have happen versus what is actually happening in the market. And the real profit is made, and the competitiveness is when you can deal with what's really going on in the market. All right, Jen, let me take some questions, please.
Okay, I'll go back to just having chart view here. Okay. After a linear break, tempo became low. What does it signify? Does it indicate inventory becoming too short, or an exhaustion of a seller, or the patience buying of the longer time frame?
I haven't seen any buying with a longer time frame of any seriousness for a long time. I think all you got was liquidation. Remember, I started off and I showed you how crazy the market went late Monday when it got down to the area where one of the big dealers had to adjust their hedge, and to adjust their hedge, they had to buy. When they bought, that triggered all the short-term traders jumped on board and bought, and they got the market ridiculously high. So you had a ridiculous run on Monday, and then all you had yesterday was liquidation of that run. So that's all that took place yesterday. Liquidation. In other words, you had old business. You had old business, not a combination of old business and new business. The market, like I say, it's on a very weak level because it's at exacting. Again, another indication of shorter term traders in the market buying exacting levels. Okay, what else?
Okay. What is your take on the Globex high in the overnight session from the 26th? How long do you consider this high relevant? How long do you consider this high relevant? I ask this because we had a low in the overnight session in August that was never revisited.
It's not something I stress out about. I'm aware of it. I'm aware of it, and it's just one factor. I don't have any great time limit on it, or anything of that nature. It's just an awareness. And if the market starts, I watched it on Monday when it couldn't get up there and it couldn't take it out, and it couldn't take it out overnight. I mean, what a great place for a short, because if it takes it out, you're out. I mean, you can get a short off there. I mean, it struggled, but it couldn't get that high out. And that gives you, it gives you a low risk short, and you got a great place for a stop. So, but I have no, it's just an observation, but I don't put any specific time on it. Okay, what else?
Okay. Jim, yesterday was the first time in 2 weeks that the break wasn't immediately bought. Do you see that as a signal for change in sentiment?
No, not necessarily. I mean, the market's, this is, what's it, 8, 1, 2, 3, 4, 5, 6, 7, 8 or 9 days. The market's just gone nowhere in there. I think you want to be alert down here. There's an awful lot of very weak longs in this market. An awful lot of laggard, weak longs. Now, as I've said many times, the institutions have been long for a long time. I mean, a lot of them have been long since 1980. I mean, and they're very complacent. Usually they don't panic unless the market's off, 8 or 9%. So yesterday, I mean, you could hear them on TV yesterday. They said, well, we've seen this before, ho hum. But if all of a sudden you do get a breakdown, they haven't, what really accelerates breaks to the downside a lot of times is they come in after the market has been off for some period of time, and they start to hit the, the second guessing button. So if this market breaks, incidentally, RJ, let's put the daily bar up one more time.
Okay, RJ, I'll give you the screen. There you go.
Okay. Okay. If this market does start to break in here, you can see there's a gap down there. But it's not the gap. Oh yeah, see the gap down here? That was where, if the market really got underway, that is where I would be looking at the potential. And I'm not suggesting a break. I'm saying if it does get underway, that would be, a really targeted area. Okay, final couple of questions.
Okay. Geopolitical news that affected crude oil yesterday. Would you trade this environment or stay away? Yesterday, crude had a 45-degree angle, which caught a lot of people short.
I don't trade it. One of the things that I talk to an awful lot of people, and hold on. And you know, there's a lot of people that very few people are successful trading. One of the things I find is people that really, they may have a lot of excitement, but really are not profitable overall, are jumping all over the market, and they go to, you know, what's ever hot. So from that aspect, I wouldn't jump over to trade crude. Yes, it's hot and it's exciting and everything else, but I like, just a personal thing, I like to stay on one or two markets that I want to know those markets, and I want to know them backwards and forward. Now, that doesn't mean I'm not aware of what crude is doing. And when crude's going up, that may put some pressure, you know, on the equities. But I do not jump to crude and then to NVIDIA. I just think that it gets your emotions going too high. Now, some people are very good at that. I'm not. I do much better by having one or two markets, concentrating and knowing those markets very well, knowing the action of the competition and how they're going to trade. Okay, final question?
Okay. Do you consider the market to be in a 9-day balance? And what do you think the likelihood is to stay in balance given the uncertainty of elections in a month?
I don't play the game of what's the likelihood of staying in balance. It's a mechanical thing. It either does or it doesn't. One of the places we get in trouble when we start saying, well, you know, I think it's going to take it out, or, you know, if it happens, you know, you apply the balance trading guidelines to this multi-day balance. If it breaks below it, it gets accepted, go with it. Breaks below it and fails, comes back up, you know, go with that. But I don't look at likelihoods. I look at what the market's doing right now. Okay, one more question.
It was just, I think, similar to the question that was asked previously about that all-time high made in the overnight. Are you just going to continue to carry that forward until it gets taken out?
Or it
And how much
doesn't.
is it? How much is it influencing your trading decisions?
No, it's one data point. It's one data point. Too many times people get over focused on a single data point, and it blocks their objectivity to the entire market. All right. Thank you very much. I hope you consider joining us for the intensive, and remember to look for the weekend short video, as well as the next article that will be out next Monday. Thank you. Have a great trading
Okay.
day.
And yep, I just want to mention shout out to Scott Schneider. Thank you for that testimonial that was posted in the web email sent out today. And just as a reminder, don't forget to use the code 50OFF to receive $50 off if you are wanting to join us for the intensive and you need to do the Foundation e-course as a prerequisite requirement. You can get an additional $50 off from today through this Friday at 11:59 p.m. Eastern Time. If you have any questions, don't hesitate to contact us, dalton@jimdaltontrading.com for our email, or you can call us at the number at the bottom of our website. Thank you so much, everybody. Thank you for joining us, and we'll see you at the next one.
Thank you.